A new report has come out showing that consumers are not feeling good about the current state of the economy, and it's getting worse with a variety of factors, including not being able to buy vehicles at the price they want, not being able to buy real estate at the price they want, inflation. There's a lot going on. So let's talk about this report and why it matters much more than you think it would, both if you're just an individual consumer and especially if you are an investor or you own any kind of assets. So this is the survey of consumers by the University of Michigan. They release a preliminary and a final report every month showing consumer confidence in a variety of areas, and this actually sways markets. So if you have any investments, this will absolutely affect your investments. And here is the website for the survey of consumers. They have some great data on here. I'll have this linked down in the description if you really want to explore through the data, but we're going to look at a bunch of the charts and explain why this matters. So this is the most recent data release. And a little bit on the survey itself. So like I said, there's two versions of the data released 2 weeks apart, preliminary and revised. And a higher than expected reading should be taken as a positive or bullish indicator for the market, and a lower than expected is, of course, the opposite. And we had a surprisingly low number with this most recent report. So we can see, we saw this sharp decline here in 2020. For obvious reasons, but then we saw, a fairly steady incline from here. There's obviously some downs, but mostly trending upwards. But in recent times, you can see that we're trending downwards pretty dramatically, and this is what's getting investors concerned, especially the big institutional money. Now, you might be thinking, a survey about how people feel financially, that can't mean much, or why would this even matter to me? And surprisingly, it does matter a lot. And that's because the stock market is an expectation machine. So people buy or sell based on the expectation of what others are going to do. And this is especially true with these big institutions who, again, buy or sell based on the expectation of what others are going to do in the market. So if a report comes out showing that the average person feels like they have less money to spend, or that this is a bad time to buy a variety of other assets, this sets an expectation that stocks will perform worse as they will have lower sales. If you have an aggregate number of consumers who feel financially insecure, they're going to spend less money. Spending less money means the companies that you spend money at have lower sales, which means lower profits, and this affects the stock market and the futures market, which is, of course, the expectations of markets in the future. And that expectation, compiled all together, leads investors to change the way that they act today. And also, to highlight the importance of this data, check out this article. It's an old article, so it's formatted pretty weird and it's cut off on the side here, but it's really interesting. So I can give you the gist. The University of Michigan had a $1 million contract with Thomson Reuters, the news agency, to get this consumer confidence data a full 5 minutes before it was released publicly. And in this way, Reuters members would get first access and be able to act on that data. However, Reuters had this ultra high level tier of data at an undisclosed price point. Who knows how much they're paying for this, that gave their customers the data 5 minutes and 2 seconds early. So they had this tier for 5 minutes early and an additional tier for an additional 2 seconds earlier than that. And data showed, because you can see when trades are executed in the stock market, that there was massive movements in the markets only milliseconds after that data was released. So you could see 5 minutes and 2 seconds early, there was massive movements in the markets. And an ex-SEC chairman had even commented on this saying, quote, "I worry that there's both a fairness and a disclosure issue here." So they're saying that this was an unfair advantage in the markets to receive that data first. That's how important and impactful this information is on the market. So the feeling of the average consumer can mean massive moves in the markets. And just to highlight the data a little bit more, they have tons of graphs that they put out. Now with the graphs, these come out even later than the actual reports. So I'm going to show you some of the older graphs, and then we're going to have to, just imagine, these graphs kind of falling off because most of these have seen a sharp drop in the recent past. So the first chart we're going to look at is just the general sentiment chart. And we can see, we had that sharp drop in 2020. It was slowly climbing back up. We saw a small dip, but it was starting to really climb up. And then the data that we don't have on this chart is we're going to see another nice drop off here. And this is just general sentiment. Next chart we have is consumer sentiment within age groups. So now I thought this was really interesting because the age group 18 to 34, the youngest age group, seems to have a much more positive sentiment of what's going on compared to the older age groups. Basically, the older the age group, the lower the sentiment here. But of course, we're going to see a drop off in all of these with the most recent data once they update these charts as well. But I thought that was interesting. Like, why do you think that the youngest of young people have a higher sentiment? Is it just less experience and older people are like, no, we know that this is worse than it seems with this inflation data coming out, 5.4%. Like, this ain't good. So let me know what you think, why young people are so much more optimistic here. And this is financial situation compared to a year ago. So it's just asking people, how do you feel about your financial situation? And we saw a nice little spike up here again in the recent past, but this is going to jump down at a pretty similar rate to this spike up in the next month once these charts are updated. And then buying conditions for houses, I mean, you can probably expect how this chart looks. It's just gone down and down and down over time, and we're seeing this real sharp drop off here. Look at the monthly data, the dotted line, just cataclysmic drop off here, and this is just going to continue down. If you use any of those sites that are like a home price estimator, your chart is going to basically be this one but flipped upside down. Like the chart for my house it's like, pretty flat, over time. I've owned the house for like 4 years, and then in the last year it's just like shoots up. Like the amount of equity that I've received in the last year is insane. It's an inverse to these buying expectations. Buying conditions for used vehicles or just vehicles in general, sorry. Basically, you can say the same chart, sharp drop off here, right about 100 now, and this is just going to go lower now that we've again seen the additional 10% increase in prices in the last month here. And of course, these are going to even out at some point, and prices can't just increase forever. There's going to be a point where you're not going to pay $100,000 for a used Toyota Camry. Of course, they can't increase forever. I mean, maybe you will. It depends on how much you like Toyota Camrys. And then we have news heard about price changes. So the sentiment here has been dropping off quite dramatically even before this most recent chart, and this is going to just trend down even lower. And this is, again, very likely due to the inflation issues and people worrying about just the overheating of the economy. Got two more charts after this. Expectation change in household income. Now this one, of course, we've seen this huge drop off here where people were very scared about losing their jobs right when the pandemic happened. A lot of people were getting laid off. Of course, that's expected, but then we saw an equally fast shoot back up, not quite to current levels, but then it's been lowering. It's been lowering. So we saw this shoot back up and it's been lowering, and we're going to see this drop even lower once this chart is updated as well. And the last chart we'll look at is consumer sentiment within income terciles. So 3 different income ranges, bottom third being this dotted line, top third being the blue line. And this isn't really surprising because the highest income earners, of course, are going to feel like they have the best sentiment. We're not really at the point now where it's like a buying opportunity if you have money, where a year ago it really was. Like if you had money, it was like, this is a great time if you have money. Not really the case anymore, so I'll be interested to see how this top income level changes with the next month because there's not really much to buy anymore at fair prices. It's hard to find great deals in most areas. So it'll be interesting to see what exactly happens there. Now, how does this affect your current investments? To me, this reads as investments are going to be relatively flat for a while. We've been receiving report after report after report that's just like, this does not look good for the economy. And then couple that with just knowing that investments are expensive right now. You look at the average PE of the S&P 500, it's high. It's like the second highest it's ever been in history. So a lack of great deals coupled with not very good sentiment and just report after report after report, that's kind of scary. I think we're going to see it fairly flat for a while. I don't think we're going to necessarily see it go down because we still have these really low interest rates. We're still having this money pumped in the economy with quantitative easing. So I don't see it, I don't see this huge correction happening or crash happening, but to expect these all-time highs to continue to skyrocket, that's probably unreasonable as well. Of course, we don't know for certain what's going to happen. I'm not a fortune teller. I don't know exactly. So if this was helpful, make sure you just like this video, subscribe, share it if you want to help spread the knowledge. If you want even more information, consider joining the Patreon. Just 2 days ago, I posted a half-hour-long private video on the Patreon on how to find good investments in this environment. So you'll want to check that out if you're looking for additional investments in the stock market. And I would just like to thank you again so much for watching, and I hope you have a profitable day.